Hello, everybody. I am Mickey Payne, the Vice President of Investments at WNBC. Today, I'm excited to present our fourth quarter market commentary. We hope you enjoy it and eagerly anticipate any feedback you might have. We're committed to providing you with information that we hope you find valuable. In this quarterly market commentary, our goal is to update you on key highlights in the economy and the changes that took place in each of the investment models during the last quarter. So, without further ado, let's get started. We wanted to make sure you're aware of a few things. One, looks like Fidelity will be sending out your 1099s on February 10th. If you have any questions or need your tax returns, please feel free to contact us. Two, our current broker-dealer, Osaic, has taken the stance that all financial advisors cannot buy Bitcoin-related investments for you. Recently, the U.S. securities regulator approved the first U.S.-listed exchange-traded funds, or ETFs, to track Bitcoin. Osaic is reviewing if they will change their stance, and once we hear back from them, we'll let you know. So let's turn the page over to the economy. Coming into 2023, for the first time since 1999, the average strategist's S&P 500 forecast for the end of the year was negative. Analyst predictions reflected deep uncertainty over U.S. monetary policy, corporate profits, and a wider debate over whether the economy would fall into a recession. Not only did the U.S. avoid a recession, but the S&P 500 returned more than 20%. As you can see in the chart, inflation peaked back in 2021 and began to cool in mid-2022, and they've continued to ease ever since. A key driver behind the recent broadening market strength was the Federal Reserve December meeting. They affirmed that rate hikes are over and rate cuts could begin in 2024. The Federal Reserve will be watching a few key indicators to determine if and when they will cut rates. One of the key indicators the Federal Reserve is watching is the unemployment rate. As you can see in the chart below, the unemployment continues to remain low. The week ending January 13, it fell to 187,000, down from 203,000 the week prior. This is barely above September 2022 low of 182,000, and it continues to trend at levels historically associated with economic growth. In the chart below, you can see how retail sales have increased and consumer confidence have picked back up. Retail sales increased by 0.6% in December to a record $709 billion. Consumer sentiment soared 13% in January to reach its highest level since July 2021, showing that the sharp increase in December was no fluke. Consumer views were supported by confidence that inflation has turned a corner and strengthening income expectation. Over the last 2 months, sentiment has climbed a cumulative 29%. The largest 2-month increase since 1991 as a recession model. With inflation cooling, yields falling, and strong consumer spending supporting the economy, markets have much to celebrate. So, with the anticipation of the Federal Reserve potentially lowering interest rates in 2024, I wanted to show you a research that reflects what happens to cash, bonds, U.S. stocks, and a 60-40 portfolio, 60% equities and 40% fixed income, after the Federal Reserve stopped raising interest rates. You can see the following last 4 tightening cycles, core bonds, U.S. stocks, and the blended hypothetical 60-40 portfolio sharply outpaced cash equivalents or 3-month treasury yields. Conversely, cash rapidly declined an average of 2.5% in 18 months after the last Fed hike. So we've been actively managing your portfolios and strategically allocating your cash according to what your model calls for. Going into an election year, there's always concerns what will happen to the markets. So I thought I'd present to you a research reflecting what has historically happened. While markets can be volatile in election years, which political party takes the White House has had little impact for long-term investors. Since 1936, the 10-year annualized return of the U.S. stocks, as measured by the S&P 500 index, made at the start of an election year was 11.2% when a Democrat won, and 10.5% in years a Republican prevailed. So it's about the same. So now let's turn over to our investment models. The first model is the WNBC quantitative model. It's designed for risk-managed performance over the long term by using several technical indicators. We review these indicators daily to tell us whether we should be in the markets, out of the markets, in bonds, minimally or maximally allocated to equity. This indicator primarily focused to identify a high probability of disturbing the markets, with the primary focus to help protect you from potential downsides in the market. In Q4, the model maintained its maximum equity exposure, while the fixed income allocation continued to remain in cash. However, back in Q1 2023, the investment committee saw that the Federal Reserve was unloading treasuries to clean up their balance sheet, and so we have been investing in treasuries since then. Any treasuries that have matured, we are reinvesting into the 9, 6, or 3-month treasury, currently yielding about 5.45%. As you may or may not know, another benefit of buying treasuries is the interest rate on treasury securities is exempt from state, but not federally income tax free. On the equity side of the model, it's called to sell the iShares, MSCI, EFA, and use that for the sell to reallocate proportionally into the existing equity investments. So the next model is the WNBC Strategic Whole Portfolio. This is designed to help investors pursue long-term investment success through fundamental research by the American Funds team. American Funds research includes thousands of face-to-face meetings with companies throughout the world. They visit factories, facilities, and headquarters to help drive deep operational understanding and inform portfolio asset allocation. A long-term approach coupled with the extensive research, fundamental research, has allowed American Funds to generate strong results versus their peers. So in Q4, the key investment themes include increasing their emerging market exposure in global-oriented capital appreciation-focused portfolios, also increasing higher yield dividend exposure relative to the core equities in equity-oriented growth and income portfolios, increasing return-seeking fixed income relative to core fixed income and select growth and income portfolios. And they also manage duration profiles in the preservation models in more conservative retirement income-focused portfolios. So in Q4, there were no reallocations that had took place. So the next model is the WNBC Ladenburg Tactical Portfolio. It's an actively managed portfolio strategy that shifts percentages of assets held in various asset class categories to take advantage of market pricing anomalies or strong market sectors. This strategy allows the portfolio managers to create an extra value by taking advantage of certain situations in the marketplace while maintaining your long-term investment goals. Managers return the portfolio to its original asset allocation once reaching the desired short-term profits. In Q4 investment theme, there were no changes in the equity or fixed income. So the next model is the WNBC Alternative Model. It's an actively managed, multi-strategy alternative investment portfolio. Our model seeks to provide you with access to unique investments opportunities that produce returns with a low correlation to a traditional investment. We have two alternative models. One, the alternative income, and two, the alternative growth. The alternative income model is more focused on generating income, while the alternative growth is more focused on generating growth. Alternative models is currently made up of institutional access to commercial real estate, institutional access to a diversified portfolio of credit instruments, and a hedge fund that is focused on long and short equity investments. In Q3, after extensive research and discussion, the investment committee agreed to invest the cash into Treasury securities for now. We continue to look for opportunities, but take a conservative approach as the market digests this year quantitative easing by the Federal Reserve. So we hope you have enjoyed this format. If you have any questions regarding your investments, feel free to contact us. Thank you for the opportunity to serve you and your investment needs.